This is an uncovered Japan company research report on Being Holdings, ticker 9145. Being is a Japanese third-party logistics specialist that keeps everyday necessities moving, from wholesalers to store shelves. The investment question is whether its current wave of new logistics centers will mature into the higher margins that this high-return business has delivered before. Being reported FY 2025 revenue of 33.52 billion yen, after a 5-year revenue CAGR of about 13.7%. Its FY 2026 guidance still calls for 10% revenue growth. The trade-off is clear. New sites and a relocation have weighed on current profit, while the top two customers account for roughly 47% of sales. Being does not simply charge by the trip. It designs and operates the chain from warehouse to store, combining warehouse management, transport control, productivity tools, and AI volume forecasting. Its daily necessities focus includes food, medicine, cosmetics, and toiletries across ambient, chilled, and frozen flows. This is why its model is better understood as software, consulting, and operations together. Revenue rose from 20.03 billion yen in FY 2021 to 33.52 billion yen in FY 2025, while operating profit roughly doubled to 2.30 billion yen. The operating margin reached 7.43% in FY 2024, then eased to 6.87% in FY 2025 as a wave of new sites loaded startup costs ahead of full utilization. The strongest risk is customer concentration. Kusuri no Aoki represented 35.5% of FY 2025 sales, and the top two customers together were roughly 47%. These are embedded, multi-year relationships with real switching costs, but a change of policy at an anchor account would still materially affect the group. The broader base is growing, with 30 customers contributing at least 100 million yen annually. The balance sheet is an important counterweight to the investment phase. The equity ratio rose from 29.4% to 40.1% over 5 years, while the interest-bearing debt ratio declined from 127.5% to 68.8%. Being has expanded a physical network while maintaining high teens to 20% returns on equity. Free cash flow fell sharply to 0.10 billion yen in FY 2025. But the report traces that to a record 2.11 billion yen of investment cash outflow, including roughly 2.02 billion yen of property, plant, and equipment purchases. Operating cash flow remained positive at 2.21 billion yen. The key signal to watch is whether free cash flow recovers as the new sites mature. Being's strategy is a repeatable cycle. It front-loads costs to launch a distribution center, absorbs the early drag, then harvests profits when that site has a full year of operation. It then redeploys the returns into further capacity. The company's systems, including its jobs AI volume forecasting, are designed to improve staffing and productivity in a labor-short industry. Capital allocation has favored reinvestment. Retained earnings increased by roughly 3.9 billion yen over 5 years, against around 1.7 billion yen of cumulative dividends. Yet the ordinary dividend has risen every year, with FY 2026 guidance of 15 yen per share. The lower payout reflects the priority of funding a high-return expansion runway, rather than a lack of shareholder returns. At the report's 5 June 2026 reference date, Being traded at 568 yen and around 9.7 times forward earnings. That was near the bottom of its own approximate historical PE range of 8.8 to 20.1 times. The market was pricing the recent profit pause. The central question is whether the margin recovers as the current center cohort matures. The research presents illustrative 3-year scenarios, not forecasts or price targets. They assume FY 2028 earnings per share of about 66, 78, and 88 yen in bear, base, and bull cases, using multiples tied to Being's history. The difference between outcomes depends mainly on margin recovery, center maturation, customer diversification, and whether the valuation re-rates. Being Holdings combines a defensible daily necessities niche, in-house logistics systems, rising dividends, and a balance sheet that has strengthened through expansion. The risks are customer concentration, cost inflation, and profit volatility during investment. The two practical questions are whether the current center cohort restores margins and free cash flow, and whether the company can broaden its customer base while extending its network nationally. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.